Hello, my name is Scott. I've been a corporate accountant for the past 10 years of my career, and the prior 8 years I have been specializing in consolidation accounting, meaning one of my primary tasks of my job is to prepare balance sheet, prepare the income statement, prepare the consolidated statement of cash flows, prepare shareholders equity roll forwards. So I am more than qualified to speak about what goes on in each of these components. And today I just want to talk about the balance sheet. And if you're analyzing a company maybe to invest in their stock, I want to talk about, is it worth looking at the balance sheet? So let's get right into it. So just a very high level overview of what's on a balance sheet. You're going to see assets like we see here, current and long term. And then we see liabilities, and we also see shareholders equity. And a balance sheet, the way it balances is your assets equal your liabilities plus your owner's equity. And when you look at current versus long term, all that means is current is 1 year or less. So if you have accounts payable here that's under current liabilities, that means that that amount is owed to that specific vendor in less than a year's time. Long term, over a year's time. So when you see long term debt, that just means that they owe that company. It doesn't have to be paid within a year. So right here, we're looking at the consolidated balance sheets of Johnson & Johnson, a very popular dividend stock and a blue chip stock in general that people like to invest into. So let's dig into it. The first and probably most important thing to realize about a balance sheet is that it's literally just a snapshot in time of the company. So when we're looking at Johnson & Johnson here, you can see that it says at January 1st and January 2nd of 2023, 2022 respectively. Notice it says at January 1, not as of January 1. And this is important because that just means as of January 1st, 2023, this is what their balance sheet looks like. And just think about that for a sec. So this is in millions, which means this cash and cash equivalents line is showing 14.1 billion, right? So theoretically, Johnson & Johnson could spend $10 billion in cash the next day, so January 2nd of 2023, and all of a sudden this 14 billion number that you see in every 10K from Johnson & Johnson at the end of the year really doesn't make, who cares? It just decreased in 10 billion. The 14 billion is no longer relevant to the case. So you just have to be very weary of using the balance sheet as a long-term projection of how the company did and where it's going. Another thing is to consider is like long-term debt too. It's considerably the same thing. So a company, Johnson & Johnson in this instance is showing as of January 1st. Well, what if their debt payments happen on the 2nd of the month? Or what if they happen annually and the debt payment just happens to be January 2nd? You could see that 26.8 billion of long-term debt all of a sudden decrease by billions of dollars, and the balance sheet wouldn't reflect any of that business that occurred. So it's just one thing to keep in mind. It also works in reverse. So they could have had maybe $8 billion in cash as of December 15th of 2022, and then 15 days later they're showing 14 billion. So it doesn't really give you the history of what happened in that account. The PL, or the income statement, is going to show you what happened for that whole year of 2022. So from January 1st, 2022, all the way to December 31st, 2022, that year-to-date income statement is going to give you the number that shows the activity for the entire year. So when it shows revenue, for example, it's showing you the revenue from January 1st all the way through December 31st of that fiscal year. The balance sheet, it's just a snapshot in time. And that's why, in my opinion, it's extremely overrated. But let's get into another thing that people often misanalyze on the balance sheet. So when people do typically analyze the balance sheet, they attack two areas almost all the time. And those areas are the cash and cash equivalents, and then your long-term debt. And it's understandable because from a common sense standpoint, if you're not really into numbers, and if you're not an accountant like I am, and if you're not really into analyzing stocks, in your head, as a normal person in society, you would think like, look, if that person on the street had $100 to their name and they were in debt, like $250,000, you immediately start thinking like, wow, that person's in terrible financial state. And they kind of do the same thing with the balance sheet. They would say, oh, your cash is really low, your long-term debt's high, this is a terrible balance sheet. You might even look at something like a Johnson & Johnson, who's an absolute cash cow, and you're saying, wow, cash and cash equivalents is $14 billion, but their long-term debt is $27 billion, almost just about. They're not really in that great of shape. And this is a bad way to analyze a company, in my opinion, if you're going to use it for investments in their stock potentially. Just remember, cash and cash equivalents, like I said, this is snapshot in time. They could be getting a huge vendor payment the very next day, the very next week, or in the month. And it could be something coming from, where do they have it listed here? Other receivables. This could be coming from, accounts receivable. So accounts receivable is basically where companies that they sold to owe them money, or Johnson & Johnson could have provided services for a company and they didn't pay right away, so that goes into their accounts receivable. The very next week after they prepare this balance sheet, one of the big vendors that owes them part of the $16 billion could say, okay, we're going to pay you in full. Here's $4 billion. All of a sudden that cash increases to $18 billion on the balance sheet, and it looks a heck of a lot better than $14 billion. That's why the snapshot in time, the balance sheet, it's just not the best way to look at a company if you're going to analyze it for investment. And another thing is like long-term debt too. You just see this huge number, and you might compare it to the last year's. Let's say like, oh, they had $29.9 billion in debt. Now it's only $26.8 billion. They're aggressively working on paying it down, right? It might not always be the case. And that's why, again, I'm like a broken record here. It's just a snapshot in time. You don't know the ins and outs. And that's why I'm going to share what the better thing to analyze a company is, and that is the statement of cash flows. So let's get into the statement of cash flows and why it is eons better than using the balance sheet to invest. So the statement of cash flows almost does the work of like showing the activity that happened throughout the year that went into that final balance sheet number. So it's almost like you're kind of making like an income statement version of the balance sheet. Now, it doesn't end like that, but basically, if you're going to just analyze a stock based on financial statements alone, which you should absolutely not do, but for me personally, the cash flow is way better than analyzing just the balance sheet. So it starts at net earnings or net loss if the company lost money overall, and then it ends at your cash and cash equivalents for the end of the year. So you saw the 14.1, and if you remember, go back to the balance sheet, it will show 14.1 in that cash and cash equivalents line. So basically, the three things that get analyzed on a cash flow are cash flows from operations, cash flows from investing activities, and cash flow from financing activities. And cash flow from operating activities is really important to tell whether a company is cash flow positive, I would say. It's a better indication of whether their business model is successful in generating revenue the right way. So you can see from cash flows from operations that Johnson & Johnson going back to 2020, it's actually decreasing year over year. So that could be a warning flag. Even though the cash and cash equivalents line looked very similar, you can see cash flow from operations is decreasing year over year. And in my opinion, cash flows from operating activities is a better way to look at the cash from the balance sheet. So if this number keeps decreasing over time, even though the ending balance of the cash on the balance sheet might end up looking similar to prior years. If your operating activity cash flow starts going down, then you might get suspicious. Well, then where is this cash actually coming from? So another reason that the cash flow is superior is, I mentioned the long-term debt. Remember, it's just a snapshot in time. But if you look at the cash flow, look at everything that gets noted in the finance activities. This is pretty much everything loan related, anything dividend related if you're analyzing a dividend stock like J&J. But finance activities is also very important if you want to analyze the debt, how much they're paying each period. And you can see they have the repayment of short-term debt and the repayment of long-term debt. It's these two lines right here. So as you can see, in 2020, they only paid $2 billion in short-term debt and $1 billion in long-term debt. And then you fast forward 2 years, they paid $6 billion in short-term debt and $2 billion in long-term debt. So again, this is important to realize because you have to understand, when is this debt going to have to get paid off? You can have long-term debt on your balance sheet that looks really bad, but if it's due in 40 years, does it really matter? And that's why looking at the cash flow is important for understanding the whole picture, because when you look at long-term debt, which is debt that needs to be paid longer than a year, it's due longer than a year in time, you can see that it started out at 1.06 billion in 2020, and then they had to pay more long-term debt. It went to 1.8 billion in 2021, and finally, in 2022, it increased to 2.1 billion that they're paying in long-term debt. Now, obviously, Johnson & Johnson, it's a huge company. It can pay this amount of money. But it's one thing to keep in mind, especially if you like investing into companies for their dividends, is that, if they have to pay off long-term debt and that numbers just keep getting bigger and bigger every year, well, can they sustain this dividend? I mean, you can see, in 2022, the dividends to the shareholders was $11.6 billion that they paid out from cash. And $11 billion, you can see they tend to increase their dividends every year. And you can see it went from $10.4 billion that they paid out in cash to $11.6 billion that they paid out in cash. So if you want to analyze a company to say, are they going to keep increasing their dividend year over year? Well, that number is getting pretty large for Johnson & Johnson. Even though they have a lot of money, they have a lot of income coming in. It's interesting to note that, $11.6 billion. And if you want them to increase, say you want to invest in this Johnson & Johnson for 20 years, what's that number going to look like in 20 years? Do you think they can sustainably raise the dividend for the next 20 years? I mean, if you just do the run rate here, where in 2 years it went from 10.4 to 11.6, so was that $1.2 billion increase? Well, times that by 10, that's what, it's like 11 billion. Can they pay off like 20 plus billion dollars to dividends? Is that going to be a problem if their long-term debt payments keep growing? So this is why, in my opinion, the cash flow is way better to use than the balance sheet when you're analyzing a company if you want to invest in them. Now, obviously, there's a lot more nuances. In the 10K, you can really drill into the debt pieces. You can see some of them show who they owe debt to, but a lot of the times the company is going to have to show what their debt structure is like, in how long is their long-term debt? Do they have to owe it in 2 years? Is this 10 plus years of long-term debt? Usually companies in their 10K are going to have to disclose, what is the maturity analysis of the debt? And then for cash, if you're talking just cash on the balance sheet, it's really not that important. You really want to focus on, is the cash flow from operating activities, is it strong? So I will say, if you're a fan of Johnson & Johnson, you're rooting for a long-term, even though this is decreasing, there's also other factors that play into it, which is why you just can't look at the financials. And obviously J&J, a little thing called COVID happened, and you better believe that J&J made a killing during the COVID era. So, cash flow from operations and their revenues might be a little more inflated during that time. So obviously, whenever you're just looking at numbers, you have to also take into account to the big picture, the macroeconomics of the thing, or if anything specific happened to this company that was external. So you have to just factor in all of that. But again, I want to stress, as an accountant, the cash flow is light years more important than the balance sheet. So hope you enjoyed this video. If you want me to break down any other parts of the 10K, just let me know. It's what I do for a living. So I'm comfortable talking about this, and I'll see you in the next video.